Today, I would like to talk stocks versus indexes and ETFs. What exactly are the differences? But before we get into it, be sure to subscribe to our channel and click the notifications button so you're always in line for our latest releases. I imagine anyone watching this video already knows what a stock is, but just to be sure, let me clarify. A stock is a small slice of a company that people can buy, allowing a claim on the company's assets and earnings. When involved in stocks, there are many things that an investor needs to be aware of. This includes quarterly earnings reports that give the public details about the last quarter and projections about future quarters. Earnings reports can move a stock dramatically, if either good or bad. It's not a good idea to be on the wrong side of an earnings report when short options. Even if we make sure to get out of any position before earnings, there are some events that are just impossible to avoid. How about the announcement that a company is changing its CEO? Depending on the company, that could be either good or bad. Would you want to be short puts in Apple when Steve Jobs announced he was leaving the company? You never know when something like that is going to happen. How about short puts in Tesla when they announced one of their cars caught on fire? Even though it wasn't a serious problem with the car, the stock dropped like a brick. How about when Chipotle had continued food poisoning problems at their restaurants that seemed to keep going on for months? The fact is, these things happen when you trade individual stocks, and you trade long enough, you will be hit by a similar situation. This is the reason why we trade many positions and keep each one small, because we never know when something like this is going to happen. If we spread out our trades over many positions, we can absorb the hit when it happens. An ETF, on the other hand, which stands for Exchange Traded Fund, is a group of assets, much like an index fund, that trades like common stock on a stock exchange. The good thing about an index or an ETF is that because they control a whole group of assets, if there's a huge event with one of those assets, it will have a minimal effect on the group as a whole. There are no earnings, no CEO dying, no building burning down, none of that. It just makes it far easier to predict. We still have to concern ourselves with industry-wide issues. For example, if there was legislation brought down restricting drug companies from raising prices, then this would affect every drug company out there. Here, the IBB and the NASDAQ Biotech Fund would get hit hard because every company in there would be affected. But for the one-time event issues that hit individual companies, ETFs and index funds do offer additional protection. The other thing I want to discuss here is the trading trends. Of course, stocks, indexes, and ETFs can always move in any direction, but keep in mind they're often setting new records. They do this because they are trading up. When was the last time you heard the S&P 500 was hitting a new low? When was the last time you heard it was hitting a new high? Indexes and most real company stocks continue to trade up, which makes it a lot more comfortable on the bull side versus the bear side. It doesn't always work out, but I find I am way more likely to get burned on the upside versus the downside, unless there is some kind of market crash. An educated trader understands that the markets can always crash, and when they do, they crash down. Markets do not crash up, they always crash down. The markets don't crash often, but when they do, if you're on the wrong side, it can sting. All right, everyone, that's the rundown on stocks versus indexes. Remember to pick up your free option trading course at optionstrategiesinsider.com.